What's up, everyone? It's Brand the Mortgage Man, and I've helped more than 10,000 home buyers over my 20+ year career in mortgages, and I'm here to help you. Are you a self-employed borrower or buyer and you're struggling to get qualified for a mortgage? If so, you're with a group of people that have the same exact issue as you. When you're self-employed and trying to qualify for a mortgage, you may be surprised to find out that you don't qualify for quite as much as you thought you did. You know how much money your business brings in, but maybe a lender isn't looking at it the same way you are. And here's why. Let's just say you're a self-employed individual and you've been in business for less than 5 years. So let's just say you've been in business 2 years, which is what a lender is going to want to see when you're self-employed. What a lender is going to do, and we're going to use 23 and 24 because now we're in the beginning of 2025, so we should know what those numbers look like. So let's just say in 2023, your business brought in $400,000. That's your business. And from that $400,000, your income, which you actually pay taxes on, was $100,000 because you had $300,000 in write-offs. Now in 2024, your business did a little bit better. Your business brought in $500,000, and once again, you had a lot of write-offs, and you actually made $150,000 from that business. So if you've been in business 2 years, what a lender is going to do if you're qualifying for a conventional mortgage is going to take the $100,000 you made in 23 plus the $150,000 you made in 2024 is going to give you $250,000 over 2 years. Now, they're not going to use $250,000 because that's what you made over 2 years. What they're going to do is they're going to take that number, they're going to divide it by the 2 years, and that's going to give you $125,000 of income to work with, right? This is your qualifying income for your purchase. Now, that's a good amount of income, but it might not be quite enough for what you're trying to qualify for. So now let's just say you're the same person, obviously, and you've been in business for 5 years or more. Once again, you're wanting to qualify for a conventional mortgage. So because you've been in business 5 years or more, we automatically only need to use the most recent year of filed tax returns to qualify. So in that case, we're using 2024. We said that your business brought in $500,000, of which you paid yourself $150,000. Because we don't have to average over 2 years, that means your qualifying income is $150,000, right? So $25,000 more than we'd be using if you were only in business for 2 years. Well, once again, maybe this $150,000 is not quite enough for you to qualify for the priced home you're looking for. So what's an alternative in those situations? Well, the best alternative when you're self-employed and you're not showing enough money on your tax returns is a bank statement loan. And there's different types of bank statement loans. You can do a personal bank statement loan, you can do a business bank statement loan. So maybe you're someone who files all of your business income on your personal tax return under Schedule C. You don't have an official business, right? Maybe you work as a 1099 individual and everything flows through onto your personal tax return, but it's still considered self-employed in the eyes of a lender. If you do that, well, you're not going to have, most likely, business bank statements. Everything goes onto your personal bank statements, I imagine. Well, you would do a personal bank statement loan. And what a lender is going to do is they're going to average either 12 months or 24 months of those bank statement deposits to determine what your income is. So for example, let's just say we're looking at this same scenario. This is you, and we're going to do a bank statement loan. So let's first look at if we're doing a bank statement loan, and let's just say it's personal or business because it's done the same way. It's just, are we using your bank statements that are in your name or we're using your bank statements that are in the name of your business? Either way, the math is still done the same way. So first, let's look at if we're going to do a 24-month average. So we're looking at 24 months. Let me write months so you don't confuse it with year. And here's your business. So if we're looking at the last 24 months, and it's a rolling 24 months, but we're in January 2025, so that would give me all of 2023 and all of 2024. I would take the $400,000 for 2023, and I would add that to the $500,000 of 2024, and this is going to give me $900,000. And I'm going to divide that by 24 months, right? We said we're doing a 24-month average here. So to figure out what your monthly income is, we take the $900,000 divided by 24, and this is going to equal $450,000, right? Now we can't use the full $450,000 because that's what we're saying your business brought in total deposits to your bank account. It doesn't mean that's what you made, right? Because your business still had expenses unless you're running 100% margin, which would be incredible, but unlikely, right? So what a lender is going to do when you're using a bank statement loan, and this is a 24-month, as we said, is they're going to take this number and they're going to divide it by 2, right? Because they're going to use a 50% expense ratio. That's what they're automatically going to assume. And if we use that 50% expense ratio, that's going to give you $225,000 a year of qualifying income, right? So this number already exceeds what it was on a 1 year. It already exceeds what it was on a 2 year substantially, right? So now we're saying if using a 24-month average, we're getting $225,000 a year of income to work off, which is $75,000 more than if you were in business 5+ years going conventional, and $100,000 more if you were doing a 2 year average going conventional, right? But what I also said is you can do a 12-month bank statement loan. Now, the thing is the rates will be a little bit higher. However, in your case, where your income increased from 2023 to 2024, which is common, right? Businesses tend to do better as years go by. So we're gonna do a 12-month average, and let's see where that comes, or not really an average, we're gonna do 12 months. Let's compare this to a 12-month bank statement loan. So we're gonna look at the most recent 12 months, which we said was $500,000, right? Because we're in the beginning of 2025, so we're looking all 2024. Once again, we're gonna divide by 2, which is that automatic 50% expense ratio, and that's gonna give us $250,000 per year of qualifying income. Once again, greater than the 24-month average, greater than the conventional 1 year, greater than the conventional 2 year average, right? $250,000. Would you say that if you're looking to buy a home, $250,000 is gonna get you a lot further than $125,000? Not that there's anything wrong with $125,000, it's good income, but $250,000 is probably gonna get you closer to where maybe you thought you wanted to be or should be when it comes to your purchase price. Keep in mind, this was using the general business expense ratio of 50%. Most lenders that offer bank statement loans, not all, but let's just say most, if you're able to get a letter from your tax preparer or CPA stating what your business expense ratio is, they can actually use less than the 50%. Let's just say it's 20%. So you get a letter from your CPA that says that your business expense ratio is not 50%, right? Maybe you just have a really low expense. Maybe you're just providing a service. You don't actually have to buy any products to sell or anything like that. So let's just say we use 20%, right? Instead of $250,000, now your expenses are only $100,000, right? Which means that you're looking at $400,000 per year of qualifying income. Much greater than the 250, much greater than any of the other numbers that we saw in here, right? So ideally, if you're self-employed and you're looking to qualify for property, but you don't want to, or you just don't pay the IRS as much as maybe they feel you should be paying them because you're writing off multiple things on your tax return, which is common for someone who's self-employed, well, you definitely want to look at a bank statement loan. You're going to have to be in business for 2 years in most cases to utilize this type of program. However, a 12-month business or personal bank statement loan where you can get a CPA letter to state what your business expense ratio is, if it's less than 50%, is going to be the best way for you to qualify for the highest purchase price if that's what you're looking for. So when it comes to time to buy a home, make sure you shop around, speak to multiple lenders so you can offer you the best terms when it comes to this type of product. And of course, as always, subscribe to my channel to see more videos just like this one and comment below if you have questions about your own scenario.